Hi folks, Chuck Gibson from Financial Perspectives in Pleasanton, California with October 2016's Charts on the Move. While we did not get a big sell-off, the normal seasonal October weakness raised its ugly head as you can see in my first chart of performance. In descending order, we see the aggregate U.S. bond index and the emerging market stocks lost 0.8%, while the Dow Jones Industrials lost slightly more than 0.9. The S&P 500 declined just under 2%, while the New York Stock Exchange and NASDAQ lost about 2.25%. Gold shed almost 3%. Europe was down 3.5%, while U.S. small caps and the miners were the big losers, closing out the month down 4.8 and 7.25% respectively. Now, let's jump to some individual charts. The first is that of the U.S. S&P 500 index. You can see that in spite of the last few months' choppy decline, we still remain above this very critical 2120 support zone. From a glass half full view, getting through October and holding critical support and remaining above a rising 200-day moving average is bullish. But from a half empty view, price has made successive lower highs, has breached this intermediate term uptrend line, all while momentum has formed bearish negative divergence. Taking a longer term perspective in my next chart, you can see the S&P 500 form this bearish rising wedge here. With negative momentum divergence, it broke down, it back-tested, chopped sideways, and then fell hard. From that decline, price rose to form this bearish rising channel, rose all the way up, and then failed at prior highs. It then broke down, back-tested, chopped sideways, and then fell hard once again. From that decline, price has risen, this time taking out those prior highs while forming a bearish rising wedge with negative momentum divergence. It has broken down and it is currently chopping sideways. The question we must ask is, will the S&P once again follow past patterns and to expect another flush down? The answer to that question for me is not yes or no, but rather 2120. Let me clarify. If price can hold this critical support level, I would expect year-end seasonality to provide a tailwind for the markets, and therefore we should rally on to new highs. If not, and we break 2120 with confirmation, I expect to see that flush down where it should test this 1820 level and maybe even further. My next chart is that of the U.S. Small Cap Index, IWM. Remember, we follow small caps because they typically lead the overall market. They will usually be the first out of the gate on the commencement of a bull market and the first to break down in a bear. You can see prices rallied from this breakdown of the rising trendline divergent high. Notice how price is once again rolling over right at the past failure level with negative divergence and a break of the rising trend line. I have added one more element to this chart in the bottom pane that I want to draw your attention to. The black line is the ratio of the broad market S&P 500 index to the small cap index. When this ratio is rising, the S&P 500 is outperforming the small caps. And the converse is true, that when it's falling, the small caps are outperforming. You can see that when the ratio crosses above the downtrend lines, the past two times has provided a good exit signal as the small caps have gone on to take a fall. The first one was a 13% decline, while the most recent one from last year came just before the index fell more than 25%. Looking at this data, investors need to be concerned if the markets are setting up once again to repeat. My next chart is of AGG, the proxy for the U.S. Aggregate Bond Index. It continues to find support and resistance in this well-defined rising channel. While small, October's decline comes as a surprise and has my attention. Normally, when stocks are weak, bonds rise as investors sell their risky stock positions and rotate that money into bonds. As you know from my first chart, virtually everything declined in October, so this did not happen. Granted, it's only 1 month, and 1 point does not make a trend. Whether the market shied away from bonds due to the Fed's threats of higher interest rates or some other reason, I don't know. What I do know is that for now, it appears that cash may be the safest haven if stock prices break down and investors continue their aversion to bonds, even though there is no yield. It's always good to remember, as everyone sees their cash level rising, it is a position. Not everything in your portfolio must be invested at all times in the markets. My next chart is that of the US dollar. Same song, 152nd verse. The bigger picture is a massively bullish pattern with huge upside if it eventually breaks out, as I expect it to do. Until that time, we are trapped in an almost 2-year consolidation zone that is now working its way up to the upper resistance boundary for the 4th time. Will this be the one, or is it just another tease? All kidding aside, once it does decide its direction out of the rectangular trading zone, the effect on every other market will be significant and deserve our ongoing attention. My last chart is that of coffee. As you know, we took a small 2% position in our risk takers accounts and wanted to provide everyone an update. This is classical technical analysis at its best. The beautiful rounding bottom basing pattern acted as a catapult, pushing prices higher. Following our process, we took half of the position off the table last week and retained the balance, letting it run as it looks like it has more room to the upside. Well, that's it for this month. I'm keeping it short and sweet. I can't wait to put the political theater behind us and allow the markets to find their eventual direction. Either way, I expect the catalyst the market is looking for will likely be found sometime this month. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this is Chuck Gibson from Financial Perspectives with October 2016's Charts on the Move.